Hello, everyone. We are going to be working exam review 1. So we have first question is about Andre Dickinson. He's the owner of Andre's Fine Wines. He owns a personal residence with a cost of $475 and a market value of $625. Now, if you're going to be preparing financial statements, which of the following concepts will be relevant to this situation? Right. So first of all, fair value, it doesn't really matter how much he paid for or how much is it worth now, or monetary unit assumption, we know it's in dollar amounts. So we could record this in our books and you don't have to worry about conversions. It's not something that we touched on. The true answer is economic entity assumption. In this case, the owner, who's Andre, his own assets should not be mixed with the company, with the business's assets. So we should not report a personal residence with business assets. So the main topic here, the main concept is the fact that there is a violation of the economic entity assumption. The personal residence is the owner, the business is the business. All right. So the right answer here is A. Okay, next one. If total liabilities increase by 8,000, so remember the accounting equation? Okay, so we have assets equal liabilities plus equity. All right. So if equity increase, see if I have a little insert here, if I can put a little shape. All right, let's use the arrow up. Okay, I see the arrow down. I don't see the arrow up here. Let me see if I see somewhere else. I think I used it before. That's why right here. Okay. Okay. If liabilities go up, how do we maintain a balance within the equation? Well, either assets will have to go up. So we can copy and paste this here. Okay, assets will also have to go up. Or we could have liability going up. Let's put another up here. Right? Liability is going up. In order to remain balanced, we would have to decrease the equity or decrease another liability. All right, so let's put the 3 options. So let's get another insert shapes. Let's use this arrow right here. Let's put it here. Okay, in that case, we would need the equity to go down to be balanced. Okay, so the correct answer is assets must have increased by the same amount, or stockholders' equity must have decreased by the same amount. Right? So the answer is C. All right. Number 3. Just remove this. Okay. Number 3. Credits. What is going on with credits? Increase, decrease, what? Again, you have assets, liabilities, and equity. Let's copy the accounting equation. Copy. Here we go. So we know that assets increase with debits. All right. So the increase is actually, let's put it here. Increases. Oh, you know what we can do? We can use the arrows. Okay. So copy and paste. Increases to assets or increases to assets will be debit. Right? And how do we increase liabilities and equity? Credit. Credit. Okay. Now, if we want to record decreases, it's the opposite. Right? So it's the exit door. If we want to record decreases, we are going to credit the asset and we're going to debit the liability and debit the equity account. It's the reverse. Okay, so the normal balance, this is right here. This is the normal. Okay, so we increase assets on the debit, we increase liabilities on the credit, and the equities on the credit. So if we want to do the opposite, if we want to decrease it, then we must do the opposite. All right. So credits will do what? Will decrease the asset, okay, and increase liabilities and increase equity, right? So the right answer right here, decrease assets, increase liabilities, is B, right? B. Okay. Next, number 4, journal entry. So in this case, what are we doing? We are buying equipment, we are buying supplies, and we are not paying cash. We are buying that on account. So let's go back to the accounting entry that we have, right? The accounting equation that we have here. Okay. So what is happening? So we have assets. Okay. I'm just going to copy it. 2 assets. Copy right here. We have equipment. And we have supplies. All right. And what else is happening? We're paying on account. So remember, on account is either a receivable or a payable. But if we're buying, it's a payable, not a receivable. Okay, but anyway, they don't give you receivable as an option, but bear that in mind, okay? We're paying, we're buying something, we're paying, so it's an accounts payable. So if we're paying, it's an obligation. If it's an obligation, it's a liability. Remember, if it's a right, it's an asset. If it's an obligation, it's a liability. So now we have a liability, okay? We have accounts payable. So what's going on with equipment? We're buying equipment. We're increasing equipment. Okay, so how do we increase an asset? Here we go. We're increasing equipment. Put the arrow right here. Okay. And how do we increase it? With a debit. Okay. We're gonna debit equipment. What else is happening? We're increasing a liability, right? We're increasing the account payable. Now we owe money. So we're increasing this liability right here. With it, account payable. How do we increase this liability? With a credit. And then we have another asset increasing, supplies. Let's copy this, put it here. Another asset increasing, another debit. So that gives away the entry. We have the 2 debits, which is the left side. Okay, so this column right here is your debits. This column right here is your credit. Left side debit, right side credit. All right, so we have 2 debits, 1 credit. So we know that equipment and supplies must be debited. What do we have? Equipment, supplies, equipment, supplies, equipment, supplies, right here. B and D. Oh, but what's going on with B? We are actually crediting the numbers instead of debiting. So the right entry is D. All right, D. Right. 5. Let's bring it up a little bit. What is going on? After business transaction has been analyzed, step number 1 in the accounting cycle, then we go into step number 2, which is reporting in the journal, the original book of entry. Okay, so that's step number 2. What's step number 3? We're gonna post to the ledger. Okay, so C is the correct answer. Did I put the answer there? Yeah. C is the correct answer. We're posting to the ledger. All right. Next one, number 6. Okay. Number 6, we have revenue recognition principle dictating that revenue should be recognized in the accounting records when, if we're using cash basis, we're going to recognize revenue when we receive cash. But remember, GAAP does not allow cash basis. We're going to be doing accrual basis. So in that case is when the performance obligation is satisfied, not when we receive the cash, when we have completed our duty, right? So it's either the shipping of a product or providing a service, all right? So in this case is B. Okay, 7. Okay. If a resource has been consumed, but a bill has not been received at the end of the accounting period, when do we recognize the expense? Well, it doesn't matter whether we have received the bill or not. The fact that we have consumed the resource, it is already an expense. So you should report, you should adjust the books. So the correct answer is C. an adjusting entry should be made recognizing the expense regardless of the bill. Okay, see, there you go. Okay, there we go. So 8, real estate. So REM Real Estate received the check for $27,000 on July 1st. And this represented a prepayment of 6 months of rent. All right, so the books will be closed at the end of July. Only 1 month has elapsed out of the 6 months. So we have 27,000 payment divided by 6 months. That means that the rental is 45 monthly rent. Okay, the monthly rent is 4,500. Okay, the total 27,000 is for 6 months. Okay, 6-month period. The end of July, only 1 month has elapsed. Now the company has the right to claim that revenue. And remember, revenues, let's go back up to the accounting equation. Okay, here, equity increases with revenues. Okay, so how do we increase equity? We credit. Okay, we credit the revenues always. And if we want to decrease a liability, because unearned revenue is a liability, you would debit the liability. So here's the complete story. Let's have all the entries so you can understand the complete story of this entry right here. Okay, here we go. What happened on July 1st is that you received cash, 27,000, and you recorded unearned service revenue. Oh, rent revenue in this case. Rent revenue for 27. Now 1 month has elapsed. So on July 31st, I don't know why I put 3 there. Here we go. July 31st, we can claim 1 month of revenues. So we need to decrease this liability and earn revenue. 1 month only. We get to claim the revenue. Okay, rent revenue for 45. So which one is that? Debit the unearned rent revenue. And we credit rent revenue. The correct answer is A. Okay. Now let me erase a few cells here. This one up. So this one is very interesting. A lot of students tripped on this. We have the following income statement information, and we need to know which, when we're closing it, we're doing closing entries, what will be included in that closing entry. So the entry to close the expense accounts includes, okay, so let's prepare a closing entry for expenses. Expenses have a normal debit balance. Remember, let's go back to the accounting equation again. Expenses decrease your equity. So how do we decrease equity? Again, decrease of equity happens with a debit. So expenses will have a debit balance. We want to close them out, we have to credit them, all right? So what do we credit to? Income summary. Okay, we're going to credit all the expenses to income summary. So we have salaries and wages, expense, rent expense, advertising, expense, supplies, expense, and insurance expense. All right, so we're going to write all the expenses that we're crediting: 3,000, 1,500, 800, 300, and 100. So the sum of all those expenses It's given to us, but let's just add it. I think it's 57 right here. Total expenses, 57. That's what you're going to debit to the income summary. So in this entry, we debit 5,700 to the income summary. A is wrong. Do we credit 1,500 to rent expense? Yes, we do. That is the correct answer. Okay, right there. Boom. That's your correct answer. B. Credit income summary? No, we're debiting the income summary. Debit the expense, salaries and wages expense? No, we're crediting the expenses, right? So the only good answer here is B. All right. Remember, word includes does not mean the entire entry. What's included in the entry, okay? Rent expense. And the last problem right here, balances that appear on the post-closing trial balance. So after you prepare all these closing entries, you're no longer going to have expenses. You're no longer going to have revenues. You're no longer going to have dividends. So the only accounts that you're going to have are the balance sheet accounts. So it's either B or D. And post-closing, obviously, it's balance sheet accounts after closing entries. The name tells you, right? Post-closing. So the answer is B. All right, guys. Good luck in your exams.